Wanted to talk about SPX, the index for the S&P 500. What happened Wednesday, Thursday, Friday? What to expect next with SPX this week? We've got economic data that's going to hit on Friday. This is a shortened holiday week, of course, but SPX moved significantly on Thursday on some news we got on Wednesday, despite other news we got on Wednesday. This week, we might see a move in SPX as well. Here's the thing. The market only cares about economic data the moment it hits. Then it seems to sort of just ignore it. And that's fine if you accept that and you watch the charts and everything, what's going on. When we get this economic data, the stock market sells off because the bond market reacts. Then the stock market stops caring. If you see that, it's an opportunity to get in on SPX and make a few bucks. Let me show you how I'm trading SPX and how I've been making some money on this. Let's jump in. Here's a look at SPX on the 4-hour bar chart. You can see the final moves there, the big yellow, red marks moving down on Thursday. Now, the information we got on Wednesday was basically the Federal Reserve, the meeting minutes from the very last meeting that they had, where many participants basically said, don't see inflation moving the way we want it to. The bond market reacted, and this is one of the key things. The stock market is basically doing whatever it wants. It believes, the stock market believes, SPX believes that the Federal Reserve is going to lower interest rates, the economy is just going to move forward, and everything is awesome. The bond market, those are some savvy traders, and they're looking at the reality, which there's the disconnect, the stock market, SPX, versus the bond market. The bond market is, when you're talking about U.S. Treasuries, this is one of the deepest markets in the world, notwithstanding the FX market. Those are some of the savviest traders on the planet. They are moving billions at a moment. There are no meme bonds. These guys work for banks. They're selling this product off to customers who are within the banks. So when the bond market looks at information, they take it seriously. They move seriously. We saw bond yields moving back up higher, hitting 4.5% on the 10-year Treasury. I look at the 10-year. It's a good in-between between the 2 and the 30. It's a good indicator. It is the benchmark investment rate. The stock market, of course, will pay attention to interest rates. They'll look at it and say, wow, interest rates are going higher. That's not good. So this is what you really need to pay attention to going into this week. We're going to get PCI data. We'll get personal incomes, personal expenditures. My two favorite economic data points to be looking at to understand what's going on with the economy. The economy is starting to flatline at a decent pace, but that rate of growth that we have been getting is slowing down. That will affect future stock prices. Because if the rate of growth of the economy slows, so does the revenue that these companies are earning. Now, of course, we saw NVIDIA print some solid numbers again. But we're also seeing that NVIDIA is a bit overpriced. It has moved down somewhat from its all-time highs. And that's sort of an outlier. We have seen a bunch of other companies printing, saying that the consumer's a bit tapped out. Now, we're not talking recession, we're just talking rate of growth. And this is something that's so important. If the bond market perceives that inflation is still lingering, then what will happen is they're going to push interest rates higher. This will affect the economy. Let's move forward a little bit. Here's a broader look at the S&P 500, SPX. What I have here is SPY stock, the Spider Select Sector ETF for the entire S&P 500, then all 11 sectors. You've got XLY stock, XLP stock, etc. You can see the list there. Some of these have outperformed the broader SPY stock itself. Just want to kind of print this so you can get a good look as to what's been going on over the past month and a half. We've seen some big gains in some of those. Utilities of all stocks have been outperforming SPY stock, interestingly, and that's because of interest rates. Here is a look at the U.S. government 10-year Treasury yield. You could see how there was a big sell-off after the Federal Reserve met and stated basically they don't really see the interest rates going higher. Yet we just got the minutes saying we might have to push interest rates higher. So on the one hand, you've got Fed Chairman Powell coming out at a statement meeting basically saying one thing and completely being contradicted by the participants of those meeting who didn't have a press conference immediately thereafter. My take on what's going to happen, the Federal Reserve needs to leave interest rates higher for longer. I don't really think they're going to pop interest rates up a little bit higher, but even if they did, maybe a quarter, maybe a half. But then they're probably done at that point. I think that they're probably going to leave interest rates exactly where they are for this foreseeable future. It might not be January, February, March, April, May until we finally see the Federal Reserve be confident that inflation is dropping below the 2% rate. That's key. Because of that, this right here, the U.S. 10-year Treasury, looking at this chart, probably see it flatline right around these interest rate yield numbers. Not necessarily moving back down to 4.3 going sub there, but definitely probably not going above 4.75. I don't see that. I think we probably see some sideways movement throughout the summer. Then we'll see with more incoming data. Here's a bigger look at the U.S. 10-year Treasury yield. You can see we kind of peaked out on this cycle up around 5%. Again, I do not see the U.S. 10-year Treasury tops back above there. This is the big sort of number that we're looking at. Here's a headline CPI inflation. Now the headline, of course, has food and energy, which tend to be very volatile. Here's a look at core. Now on Friday, we get PCI price index, the deflator. And this mirrors CPI. We did see a move lower in inflation, but it's progressively getting lower, not at the pace that the Federal Reserve is looking for. Inflation right now, the inflation rate is at 3.6%. Given the month over month, you're looking at an inflation rate year over year. If we continued at this level, month after month after month, with the same inflation rate increase month after month, guess what happens? They would drive interest rates up much, much higher. But we'll probably see everything kind of slow down. The big take is that inflation numbers follow what goes on with personal incomes and personal expenditures. Incomes are starting to flatline out. Expenditures are following. There's a lag in price numbers. We'll probably see these numbers moving lower, but it's going to take some time. The Federal Reserve isn't confident yet. Here is really kind of the key takeaway that I'm looking at. Core PCI inflation versus personal consumption. Now, the green line is personal consumption. We're flatlining and kind of moving back downward. Friday's number, to me, is going to be very important to see what's going on with incomes, what's going on with consumption. If we continue to see numbers moving lower, this means that the consumer is starting to slow down to a point where revenues for companies are slowing down significantly. Stock prices are all going to come into check real fast. The thing is, this is summertime. We may not see any kind of real significant moves until September, October, November, especially after the election. In the meantime, notice on this chart, there's a lag. All right? Consumptions move. Maybe they slow down, maybe they move up on a year-over-year rate of change. Inflation numbers lag by some period of time. We are seeing personal consumption expenditures flatlining, starting to move sideways to downways. This means inflation will follow, but it's going to take time. Given that, my take on the overall picture for what's going on with SPX for this week, it's a shortened holiday week. It is the summertime. Very likely a lot of market participants are pretty much going to be yawning away as they get busy with summer. Not significant moves for SPX, but on Friday we do get that information, the data points coming out on Friday moving forward. I think we're largely going to see SPX moving sideways throughout summer along with bond rates, but that's really what you want to be paying attention to, because if the bond market starts pushing yields up higher and higher because of incoming data, this will significantly affect what happens in SPX. Given that, I really see that we won't see any big moves until September, October, November. Make sure to hit the like and follow button down below to keep up to date with what's going to happen next with SPX, the index versus S&P 500. Also, some of the other stocks that I've been following along and putting video content out for. Make sure to hit the like and follow button to stay up to date on that. We'll see you in the next video.